We will get started. It's noon and we have a great panel here today. Welcome everybody. I'm Aradhana Kejriwal, the president of the Atlanta Society of Finance and Investment Professionals. Welcome all of you here today. We have a fabulous audience, so we're really excited today. Just before we get started, some of our upcoming events. We have a research challenge coming up this Saturday at the Kennesaw State University. We have a record number of 19 teams from across the Southeast participating in the research challenge. So if you would like to attend, it's from 9 a.m. to 4 p.m. at the Kennesaw State University. And in the past, we've had some of our winners go up all the way to the national level. So it is an exciting event to watch these students. On March 8th, to celebrate the Women's Month, we have a Women Networking in Finance event. It's the first event that we're organizing by the Atlanta Society, where we are inviting women in finance in Atlanta from all corporations, groups, women's groups to come and attend. It's a free event and it's for networking and just meeting other women in finance. So the event is also posted on our website. If you want to pass it on to the other women in your firm, please do. And it's a great way to network and meet other women in the city. On March 14th, we have an asset owners panel discussion, and that is targeting our pension and institutional members. And on March 28th, we have a lunch with the president of the Federal Reserve Bank of Atlanta, Dr. Raphael Bostic. So that's another really exciting event coming up. So look forward to seeing such a great audience at all our events. All right, so let's start with our panelists today. We have with us Emmanuel Aidoo, who's a director and head of emerging technology in the Global Markets Division at Credit Suisse. He's responsible for coming up and executing the bank's blockchain and cryptocurrency strategy. He's worked for 2 decades at Credit Suisse and has held various senior roles, including global head of debt capital markets technology, global head of leverage finance technology, and he has spent the last 2 years plus spearheading the bank's blockchain practice. So welcome, Emmanuel. We also have Brian Sewell, who's the founder and CEO of American Bitcoin Academy. He is a thought leader in cryptocurrency education. Mr. Sewell is a serial entrepreneur who has owned several companies in the technology, energy, and manufacturing industries. He's a former executive of the World Savings Loan, a Fortune 500 company that was purchased by Wells Fargo. His passion for entrepreneurship and learning from the best leaders in the world has led him to host the internationally acclaimed entrepreneurial radio broadcast, The Brian Sewell Show. Welcome. We also have with us Kell, who's the co-founder of Verady, the cryptocurrency accounting and audit technology company. At Verady, Kell leads product direction and business development efforts. Prior to Verady, Kell started Coin Clients in 2013 to advance regulatory innovation in Bitcoin. Before that, he co-founded multiple fintech startups, including a market-leading real-time credit and risk assessment company that was acquired into Fair Isaac Corporation. Our moderator today is Paul Condra. He joined Credit Suisse in 2015, responsible for coverage of payments and financial technology industry. He previously covered the sector at BMO Capital Markets and has also helped co-found a research firm that provides services to the real estate and legal industries. So we have an esteemed panel here, ladies and gentlemen. Let's give them a big round of applause and get started.
Thanks for the introductions. When you say 2 decades, it does sound a bit long, doesn't it? Hi guys, my name is Emmanuel Aidoo, as introduced. tell by the accent, I'm not from Atlanta. I'm actually from the UK. I've been living in New York for about the last 14 years, and I just can't seem to shake this accent. I've actually been doing crypto strategy and blockchain at CS for about 3.5 years. I probably need to update my bio. I've been asked to do a few words of intro, and I thought what might be useful, and this is something that I'm sure if you've been to blockchain events like this before, you always get asked, in a show of hands. I wanted to see what we can level set and see, you know, maybe the right question is, how many people in this room 3 years ago knew about blockchain, crypto, and yeah, raise, show your hands, 3 years ago. It's about 10-15% of you. How about 2 years ago? A few more of us, good, like it. How about a year ago? Otherwise, and everyone else been under a rock. 6 months. All right, so, because even my mother's buying Bitcoin, so I know you guys must have heard about it. I understand this is a record crowd here as well. So I was asked to talk open remarks. I thought, given the show of hands, what that shows is that for most of us, we're really kind of new to what this is. I work at Credit Suisse, been there for the last 20 years, as mentioned. Always in technology. My background is software engineering, but it's really more like product design these days. I thought it might be useful, particularly given it's the CFA, to talk about why it's important to banks and why we care. But before I do that, I have to kind of level set on what the technology is, and it's going to take me maybe 60 seconds to bear with me. I'm sure my co-panelists will get into it in a bit more detail. But what's important when we think about the technology is really two things. It's an opportunity to reduce costs. That's how banks have seen it. When I first was asked to look at cryptocurrencies for the bank, it was really, is this thing going to disrupt us or not? And what we decided about 3.5 years ago was that it's not going to happen in the way we might have first thought, or maybe in the way that Bitcoin was designed. And part of the reason for that is the very regulations that we've all bemoaned in our industry are the very things that almost create a wall around us. If you touch someone's private key, we'll talk about that later on, you effectively become they're a custodian, which basically means you're a bank, and if you're a bank, then you can be regulated, and then the wall goes up. And a lot of these startups realized that a few years back and pivoted from trying to be banks effectively to be software companies. And that's when you found banks like ours looking at the technology and thinking about how we could actually harness it to make ourselves more efficient. The thing that we have to bear in mind is there's something called a smart contract. I think we'll get into that later on. But a smart contract is really, it's just code that is, it's just code that is signed into the blockchain by the participants using it, and it executes the code as we've all signed an agreement. So the blockchain not only stores data across everybody's system, everyone's network, exactly, but it also performs and ensures that logic performed on that data is also performed in the same way. And that's kind of the Ethereum model. So bearing that in mind, why do banks care? Why should we care? But it's really about ROE. It's about return on equity. Simple formula: revenue minus cost divided by capital. So on the cost line, smart contracts are a kind of primary mechanism for automating our operational processes, I call it. There's kind of two things smart contracts do. They either codify operational processes, i.e. take almost like a lean process or a lean approach to our back office, to our middle office, and share it, unify it across the entire network. Or, much more ambitious, they codify legal prose. So there are some experiments where you combine like NLP, natural language processing. They actually read a legal contract, infer computer code from it, and then execute that code on the blockchain. Very impressive. We've done experiments with interest rate swaps doing just exactly that. But then the big kicker actually is on the denominator in that kind of ROE equation. And that denominator is made up of three main factors. It's capital, it's operational risk, and it's the capital line is credit risk, market risk, and operational risk. And what we're going to discuss throughout the panel discussion, I think, is how blockchains help to reduce that. So the very things that have made banks a little less profitable over the last 9 years or so, actually blockchain gives an opportunity to do that. So one of the examples would be if I were to lend Charles at the front of the shirt, I lend Charles $1 million for 30 days versus $1 million for a week, which is less risky. Clearly a week is better than 30 days from my perspective, because I don't have to wait 30 days to see if you're going to pay me back. If I change it from a week to a day, or reduce it to an hour, each time I'm reducing the amount of time I'm exposed to Charles's credit, I'm actually reducing my credit exposure. And since credit is a big piece of what the denominator is all about, that's really why banks were trying to take the regular securities transactions, compress the settlement of those, thereby reducing our balance sheet impact. And then the other piece of it, which is less obvious but even bigger, operational risk. So we'll talk about this as well. If everybody's got the same version of the truth on a shared distributed ledger, that means that we don't have to reconcile. And if we don't have to reconcile anymore, think about what reconciliations do. They allow us to identify and control operational breaks. So the big argument amongst banks and why we care about this technology so much, why we're looking at it, investing in it, is because we understand that if we can agree on both the state of a transaction and also the data that acts upon that transaction to calculate, say, interest or anything else, and we can do that without middle and back office to tie these things together, that's a pretty big deal. And we basically eliminate or reduce our operational risk exposure, really reducing the denominator. So those two factors are why banks care. That's what the big fuss is all about. If you think about where we got this technology from, we're all Bitcoin inspired, so to speak. Bitcoin's running since 2009. These guys are transferring Bitcoin value between each other in about 10 minutes without a middle and back office doing any of that kind of verification. If I switch the word Bitcoin for a second, and since I'm in Atlanta, I'll use the example of shares of Coca-Cola. Now, we transfer that in about 10 minutes. That's a pretty big deal. Because today that takes 2 days and ties up capital, and you have middle and back office looking for errors and mistakes. Tomorrow, that's all gone. And that's the big deal. I'm going to stop talking because I think we're going to get into panel discussion. I hope I haven't killed half your questions there, Paul. But anyway, I'm going to sit down and first question.
Okay, great, thanks. Yeah, my name is Condra, and I cover financial technology, payments at Credit Suisse, and thank you guys all for joining us today. Emmanuel, that was a good way of kind of framing up, I think, from an institutional perspective. I wondered if we could just get thoughts from Brian, both Kell, just a little more detail on your interaction with blockchain and the crypto world, maybe starting with you, Kell. Talk about what kind of services you're providing at Verady, and what does a client engagement kind of look like? What is kind of value that you bring to the space?
Hi. So what we do at Verady is something that's really not that sexy, I guess, to the majority of the people in the cryptocurrency world, the blockchain world. There are a lot of other projects and businesses that are going about some really high-level stuff. We're simply trying to do the blocking and tackling, as we call it, in terms of getting a handle on all the currencies and the accounting and audit thereof. So there's a lot of growth in valuation, growth in adoption, and growth in diversity in what I call blockchain assets. And the reason I say blockchain assets is that I kind of divide it into a series of different things. One is what I call a protocol token, which is kind of the native coin on a blockchain. So it's Litecoin on Litecoin, it's Ether on Ethereum, it's Bitcoin on Bitcoin. And then you have tokenization, which I think we can talk a little bit later on in more detail, but you've got tokens that represent things that are actually on another blockchain, say like Ethereum with an ERC20 contract. And that's actually a smart contract that actually creates these tokens that you've probably heard a lot about. And then within those tokens, you have representative tokens that maybe represent a bond, a piece of art, diamonds, gold. RMG is a token that represents ounces of gold that's present in the Bank of England, actually. And then, of course, everyone has probably heard of ICO tokens, where you have a company in general that is issuing a token that serves as a private currency for the services of that particular company. So you've got a variety of blockchains. It seems like there's a new one coming out every week or so. I know with ICO tokens in particular, there's upwards of 20 to 30 coming out on a weekly basis, if not daily sometimes. And the issue with that is that there isn't really a good way to, on a multi-chain or multi-blockchain asset, to account and audit for these. So when you have upwards of $500 billion worth of value in these blockchains, whether on native protocol tokens or on the tokens that are representative or ICO tokens, they need to be accounted for and they need to be audited so that we can know where the value is and ascribe the ownership of that. So one of the things that's really interesting about what we do in terms of the starting of it is that a lot of people think they own cryptocurrency that's on an exchange, say Gemini or Coinbase. I'm kind of old school, and I think we could have a deeper technical conversation or legal conversation about what constitutes ownership of cryptocurrency or blockchain assets. To me, the ultimate ownership record is when you own the private key to the address that holds that asset. If you're working with an exchange, and maybe that's overseas, maybe it's outside the United States regulatory purview, and you have a situation where you think you own coins, you may not actually own that until you transfer it over. So we start with ownership, we prove that, and then we go through with our accounting software and we can audit the valuations of those, and on a daily basis we take it and we can transform it as we monitor blockchain wallets and then have that imported into either QuickBooks or Xero for business use. So we're targeting businesses, we're targeting ones that need due diligence for investment. They need independently audited financial statements so that they can present it to their board, to their investors for regulatory purposes. And that's kind of the basis of what we're doing. In actual parallel to that, we've also pioneered a network that puts together verifiers of multiple blockchains to enable one source of accounting for all blockchains that are relevant to that particular company, so that you can do both Bitcoin, Bitcoin Cash, Bitcoin Gold, ICO tokens, and Ether. So that's a lot, but that's what we do, and we find it pretty interesting.
Just quickly, I mean, are most of your clients hedge funds, investment firms, or is it really more businesses that may have some functional reason for owning these tokens and coins?
So currently it's functional, and we're working with miners, ICOs, hedge funds, and operating companies such as payment processing companies in the crypto space. But I have a couple of terms that I've kind of created. One is crypto using companies, and that's ones where the use of crypto is intrinsic to their company and their operations. And then I'm seeing the evolution of what I call crypto incidental companies. And that is companies that have acquired crypto for some purpose. Maybe they're in the technology or banking field and they've acquired Ether to do a POC or do some kind of pilot. At the end of the day, the CFO, Bob, has got to go, all right, Joe, you bought like 5,000 Ether, a year ago to do this POC, and that's great, and I appreciate you need that for your IT POC or pilot, but I've got to do books. How do I put that on my books? What kind of asset is it? Do I have gains? Do I have losses? Do I have liabilities associated with that? And we're looking to help with that and providing kind of a bank statement for blockchain with the incidental crypto companies, as I call them.
And how are you making those decisions on how to account for it?
With help. We have an accounting advisory board, and we work very closely with a top 50 accounting firm as well as another firm that helps with our exact treatment of it. It's an evolving field. I know that there's a lot of interest in the actual tracking of it, and what do you do with valuations on tokens that are thinly traded? What do you do with tax treatment, which is something that we're not completely in yet. We may end up partnering on that because it's a field that's really kind of changing rapidly. There's discussions about tax law treatment being done according to wallets, which might be another reason to move your cryptocurrency off the exchange afterwards, because then you can enable tax law treatment. So it's an evolving field, but right now, at the end of the day, you've got to start filing, your reports. You've got to have your books, and we'll move with that as standards, emerge and evolve.
Great. Great. Thanks, Brian.
Well, first I'd like to thank our host, ASFIP, for hosting this event today. So this is great to have us all here. It's great to meet the panel, and it's great to meet you. I hope to talk with you guys as much as we can today. The second thing is I have an institutional background. I was an executive within a Fortune 500 bank, but have been an entrepreneur for the last 13 years. And I come at this space a little bit differently, as I've made my living in this space for the last 5 years. I trade millions in cryptocurrency a day as a liquidity provider, also as a manager of a hedge fund. And then I have students all over the world in which I educate and teach how to navigate the compliance issues, the criminal activity goes on and so forth. And so it's interesting all the perspectives that we have, and I really appreciate them. I think they're wonderful. Bitcoin is a complex technology. I'm going to try not to get heady with you at all. We've got plenty of heads in the room, right, to get heady. But I'd like to just lay the foundation with saying what Bitcoin really is from a high level, very high level philosophical view. When I say Bitcoin, I mean all cryptocurrencies. The word at the top of Satoshi Nakamoto's white paper was Bitcoin. And in that white paper, he invented digital scarcity, a system of trust where power is not vested in a central authority, and various other inventions that happen in there based on 4 fundamental technologies: peer-to-peer, cryptography, proof of work, right, blockchain technology. But what is it, right? And I think the best metaphor that I found to use to help connect with people that have experienced the internet over the last couple of decades, right? What is the internet? What is the fundamental shift that has taken place in our world? What was the fundamental invention? To answer that question, the internet is a technology that enabled the free flow of information. And when you enable the free flow of information, what you create is an environment in which innovation can happen in people's garages, in countries where we're not used to innovation coming from. Innovation happens at such a rapid rate that we begin to, it completely transformed our world. Everyone here in the room, the internet touches your life in every single way, which we couldn't have predicted in 1991 when I was typing an email from a DOS prompt, right? And sitting there creating that little email. 20 years later, before my mother was sending emails, right? And we probably share that experience. So the internet enabled the free flow of information, and that empowered innovation to happen at the bleeding edge of this technology. And then it completely changed our world over the next following decades. Bitcoin is a terrible name. Even blockchain is a terrible name. Or distributed ledgers is a terrible name. I coined the word value network. Bitcoin, or cryptocurrency, whatever word you want to attach to it, I call it the value network. It's a technology that enables the free flow of value. And when you enable the free flow of value, what's happening right now, and what's going to continue to happen, is you're having an acceleration of innovation that's taking place. As Kell said, we've got new tokens coming up, every week practically, right? And so innovation is happening at a pace that we've not really seen before since the invention of the internet. And because of the profound implications of expressing value as a society, as mankind, it's a mode of communication, it's going to have a more profound effect, and this is my opinion, than even the internet itself throughout the world. By enabling this free flow of value, and having innovators now being able to innovate on the cutting edge of this fundamental technology shift, it will completely, in my view, transform our world over the next 20 years. And to view Bitcoin or cryptocurrencies as a new system of money is like viewing the internet as email. Our scope and our ability to comprehend it is very limited based on what we see. I personally have been living in this space for 5 years now, and I personally am not able to see what cryptocurrencies is going to become. I have a lot of ideas. I eat, sleep, and breathe this technology. I talk to people on the street that use it every single day, and still, we really don't know how this is going to impact the world. but we have a great example, which is the internet. And I think that that's a great metaphor to lay the foundation of where we're going with this. This is a fundamental shift. It's a fundamental innovation that enables the free flow of value, where innovations happen at a very rapid pace. And it's going to happen and change our world over the next couple of decades. Anyway.
Thanks. I think that when we have this discussion, it's important to point out that there's sort of these two ongoing tracks. There's the enterprise side, which is a lot of what Emmanuel was talking about, and then there's the public blockchain, the cryptocurrencies, which I think you were alluding to. And I think maybe it's also useful to try to distinguish between the two and talk about the merits of one versus the other. So maybe, Emmanuel, we could just start with you. Give us kind of your overview of when you think of it from an enterprise perspective, and why we shouldn't think about that as a cryptocurrency in the same kind of conversation.
I'm going to do that, but I'm going to talk about the comments over here. I agree, but I'm not going to disagree with you guys. I'm just going to add a little leg, a little tiramisu on top. So I think what I tried not to do was describe what blockchain was, what Bitcoin is, but I think it's probably worthwhile because we're going quite deep, right? So it's what Bitcoin established in 2009. If you don't read the white, it's only 8 pages, so it's not that hard to read. But if you don't want to read it, basically it enabled trustless peer-to-peer transfer of value, to your point. And it solved something called the double spend problem. Because in order to figure out what this is, and making the equivalence to the internet, you kind of have to know what technology was it really trying to solve. Before you get into whether it's a private blockchain or a public blockchain, what is the technology? What problem are we trying to solve? And the problem trying to solve is this double spend problem. How many people in the room know what the double spend problem even is? Like less than the people that said they knew about blockchain 3 years ago. So the double spend problem it's a computer science problem, and it's this idea that okay, let's take 2 minutes. You got 2 minutes for me? I can do this, right? Sure. So I think it's important. Just given the lack of hands that went up, I think it's important to know what this is. So nobody in this room believes in alchemy, right? So you don't believe I can go in my kitchen and make gold. The amount of gold on this planet was created in the Big Bang. It exists under the earth, and most of it is actually where we can't get to as humans. We all agree that's the state of play. Well, digitally, copying something is really, really easy. Right? So I'm a huge fan of Beyonce. I know you guys are in here too. So if I have a Beyonce album, Lemonade, and I want to send it to you digitally, I can send you a perfect digital copy of that album such that you couldn't tell if it was a copy or not, or a duplicate or not. You couldn't tell what the original was, right? Now, if I sent, sorry, you right here, what's your name? Yeah, you.
Ben.
Ben. So I'm sending Ben a copy of Lemonade digitally. He doesn't know, and the trouble he has right now, if I send it to him digitally, and everyone in this room can nod and say, you all believe I can make a copy of this album and send it to Ben, and it'll be a 100% digital replica. The problem is Ben doesn't know if I still have a copy of the song. If I do the exact same thing with $100, I send Ben $100 digitally, he doesn't know if I still have $100, like a yo-yo. And then I can send it to Ian. Yeah, I got your name, you can see it. Pretty cool. I love name badges, by the way. They're a great invention. So I can send it to Ian, and I can keep sending the same $100, and that's kind of the double spend problem. So what we have, and the reason why banks exist, is because we don't trust that Emmanuel didn't just create and fabricate his own $100 digitally. We rely on a trusted intermediary, third party called a bank, to actually do the debit and credit. So when I send Ian $100 in Venmo, PayPal, you name your service, what I'm actually doing is instructing my bank to debit the account, the ledger they hold for me, by $100 and credit Ian. And that problem is what Satoshi solved in the double spend problem. Now I can actually send it to Ian, and he can receive it, knowing for 100% certainty that I no longer possess the $100. That's the double spend problem. How do they do it? Let's imagine for a second this room is a safety deposit room. And if I walk in with the key to box 201, and by the way, in the box, only one key per box. If I give Ian the key and he walks in instead, he now has access to the box and I don't. And that's kind of what's happening in, so it's not an accident why it's 21 million coins created, because it follows almost how gold is thought of. You end up with a fixed set amount, and what we're doing is we're not actually making a copy of the melodic song. I'm actually assigning the value to you. I'm actually giving you the key, and then now you can go and open it. And that's kind of what's happening. And then just to get into the last little piece of this, just to make it kind of marinate a little bit more, the whole smart contract piece. So in 2013-ish, in order to make this thing even more useful, what folks did was they said, wouldn't it be really cool if in Bitcoin is 42 bytes, and then the 8 bytes is a memo field. It's just like when you write a check and you write a little note on the side, it's like that, 8 bytes. And they said, wouldn't it be really cool if we added, making it up, the deed to this hotel. If I add the deed to this hotel into that memo field and I send it to Ian, and if I was the owner of that, let's call it a bearer asset. I know the deed to the hotel is not a bearer asset, but let's bear with me. And I send it to Ian. Now Ian has provable evidence that I've just the owner of the asset, the hotel, transferred it to Ian. And now is he the owner? And if that holds water, I've just used this protocol, almost like a notary service, to add a transaction to send to Ian. Now bear with me a second. Now we move to Ethereum. What's that all about? Well, rather than have a static bearer asset in that memo field, the idea was, why can't we add computer code? And if then the computer code can execute something that I've signed and I've signed to Ian, and now it can execute something that we both agree to. And it does it without using middle and back office. So that's what the important network that we're creating is. And 30 seconds more. Going back to your question about permission versus private, there is no real, the only difference is who can join the network. So in a private network, only people that are in my club can join. And because of that, I can actually make a trade-off. The trade-off I can make is that I can change the way I provide consensus. So 150 people in this room, roughly? Great. 100 people in this room. If I want to do a private network, all of you guys, because you got in the room, you're all members of my network. I've KYC'd you all, I know who you all are, and our consensus method is going to be something called BFT, presenting fault tolerant. So what happens now is everyone, the next transaction we're going to add to our collective network of databases, each one has their own database, is going to be the answer for 2 plus 2. Sam, what's the answer for 2 plus 2?
I'm going to go with 4.
You're going to go with 4? Perfect. Everyone else get 4? Anyone not get 4? Great. So we're going to add 4, right? And that's a way, in a private room, we can do that. We can add a transaction and we all got the same answer. We weren't allowed not to answer it and wait for the answer. We all calculated it. We got 4. No one knew I was going to randomly ask Sam to be the person that told us what the answer was. And that kind of makes it hacker-proof. Because a hacker would have had to have hacked 2/3 of us to lay in wait in order to get to the next transaction.
Emmanuel, I got 5.
You got 5? If he got 5, we vote him off the island. Because we all got 4, and there must be something wrong with your system because we're all running the same code. Right? And so the only way, the reason why that works in a private network is because a hacker, there's 150 of us, would have had to have added 300 additional people in order to overpower us and tell us that actually it was 5. 2 plus 2 was 5. I'm going to stop there.
Right. Yeah, I would have to convince 76 of you that it was 5.
Right.
In order for it to actually be 5 on our network.
You'd have to, that's correct, 2/3.
Right.
Plus 100.
I was thinking over.
You'd have to get 100 of them to that 2 plus 2 was 5.
51%. Right.
It depends on the algorithm, but yeah. And so what we do is we actually change the person each time. So 3 plus 3 is Duncan's turn.
6.
Wonderful. Everyone got 6. Perfect. We had 6. We added 6. So every time we keep changing. Well done. Yeah. I've done this before, and people got the wrong answer. By the way, they thought it was a trick question. So, and then this is how it works. Sorry?
It does assume base 10. 2 plus 2 is 4, and any base 4 or higher. But if it's lower than base 4, it's not.
There's always one person. No, thank you for that. All right, I'm going to put.
on
put
camera.
Well, okay, so let's kind of stick with this explanatory kind of discussion. So how does the network get built? How do we go from one guy that has this interesting software idea to a network of thousands of nodes around the world that want to accept these transactions and either all confirm or deny them?
I'm probably going to repeat a little bit of information. We're not going to do math though. But I think people, it's, you know, let's just start at the very basics. One, there is no blockchain. There are hundreds of blockchains, okay? And some are public, meaning that anyone in the world can participate. And the two biggest examples of this by market cap and probably by number of nodes is Ethereum and Bitcoin, okay? The primary use case right there for now, besides CryptoKitties, is the transfer of value. And Ethereum has capabilities of doing smart contracts, and Bitcoin really kind of doesn't. It's got limited capabilities, but no one really uses that. And those are public networks, primarily used for transfer of value. They have some capabilities of smart contracts, especially as you get more and more evolved ones. And that's what most people think about when they hear the news or see CNBC and they think about value. Financial being, you know, the first most, you know, widely adopted use. And, you know, probably primarily because Bitcoin was the first blockchain with a consensus mechanism. Now, when you start looking at, you can either call it private, you can call it consortium, but you've got people, and typically what you'll want is more than one entity associated with that. And what I see is that one of the second best coming is for private blockchains or consortium blockchains is like, for example, settlement with between banks, where there's, you know, technologies that are developed like Corda from R3, which is another blockchain implementation because there are hundreds. And then you look at something like supply chain, where maybe you've got pharmaceuticals, a great example, where you've got your sourcing ingredients from multiple places. You have a factory that creates the pharmaceutical drug. It goes through customs, it gets shipped, comes back in through customs, goes to a distributor, goes to a hospital, goes to a pharmacy, to the end user. There's lots of reasons to track immutably and be able to prove who has that where. There's diversion, where it's either stolen or there's counterfeit drugs put in place. There's problems with lots, where you have bad lots that are created. You need to know what the origin of the ingredients were from one entity, the factory that put it together, the shippers, the distributors, everyone that was involved in that to track that down. So if you have a private consortium blockchain where everyone sees one version of the truth and knows where that one particular pill is, at all places do that, from the very origin product or the origin ingredient to Jane taking that pill and having an issue with it, that creates an immutable, trackable chain throughout the trading partnership that's there. And that's really one of the best use cases of what I call consortium or private blockchains. So I think people need to know that, or maybe I'm just reiterating what people know, that there's private implementations, usually with trading partners. If you're using it within one entity, you're probably just misusing blockchain for some reason. Like you got funding for it or something like that, and you really want to use a very slow database that has capabilities that you're not using within one entity. But you know, you need more than one entity participating to really realize the value of consensus and one version of the truth. So I just want to kind of lay that out there as far as public versus private or consortium chains.
Okay, go ahead.
Brian, did you?
Can I say one more thing? Just one, I promise, one more thing.
Okay, you can talk, man.
What we just described was blockchains are really just databases. But they're databases that allow you, with certainty, with mathematical and cryptographic certainty, to know that you're looking at the same records even through your own firewalls. That's really what we're talking about. And then we're going to get the tokens, right?
Yeah.
Go
I don't know where I'm going. Where do you want to go?
Well, I was going to follow up on just a question on the consortiums, because to your point, you need many industry players to sort of agree on, I guess, the platform, the software that everybody's going to use that gives you the version of the truth. But historically, what we've seen is, you know, companies within an industry, they're all competing with each other. And so, especially in the financial industry, right? They're partners, but they're also competing. And so, how do we get these consortiums to actually work together in a way or kind of get over that hump to where, look, on the other side, this is going to be better for all of us. But in the meantime, it might be kind of painful, and we're not really sure, who might get a little bit of an advantage here and there, and how it's all going to shake out. So, any kind of thoughts on that? Is that sort of a permanent impediment to consortium blockchain, or is that something that can resolve itself?
I know he'll follow up, so he'll correct anything I say incorrect. Right now, I see a lot of the enterprise use. Well, there's two ways. You can either have it among competitors. I mean, I think what's the estimation on bank saving and settlement costs? It's in the billions. Okay, so that's a really easy. They have to settle anyway, right? This is not a competitive environment. They're just trying to reduce their risk and increase settlement, and it helps everyone, right? So when it's horizontal like that, as I call it, there's not a problem because it's helping the entire industry, and everyone else, just goes to a new level. And I think that's fine. And then the other situations, I think, if you're looking at a supply chain for pharmaceuticals, you're kind of looking at vertical integration, right? So the people who are producing the origin ingredients are not in competition with the factory, are not in competition with the international shipper, are not in competition with the hospitals and pharmacy. So I don't think that's an issue yet. I think at some point we will have to have interconnectivity between differing blockchains if they come into greater use, and you've got an enterprise that shipper maybe is contributing or playing a part to, say, 16 different blockchains and different implementations. But there's things like the Blockchain and Transport Alliance and other organizations that are starting to work at it. And that brings me to just a point I want to make to people. So the first Bitcoin transaction happened in 2009, and nothing really happened. We had a little spike in 2013, and then 2017 happened, right? Ethereum has been doing live transactions less than 3 years from today, okay? So let's say 2.5 years, something like that. For people, the intensity of the high publicity adoption is kind of outpacing the innovation, which is crazy because the innovation rate is huge already, but people are somewhat expecting things like the technology's been around a decade. We were talking about something that was a blank screen that programmers started typing into when you talk about smart contracts particularly, like less than 3 years ago. And I think some people have to really kind of get that in their head and realize two things. One is you're asking something from a very young, very powerful technology that it will get there. I mean, it's just very young right now. And two, it's actually pretty amazing if you look at that and say it's less than 3 years old, and the entire world is going gaga over it based on the capabilities. So I just would ask for people to look at it from those two standpoints. One, it's coming, but it hadn't been around that long. And my Lord, based on how long it's been around, what an impact it's made.
Yeah. And I guess to put the adoption in perspective, I think less than 1%, maybe even 0.5% really have adopted the technology. And we'll probably be in the 50%, in the next 10, 15 years as far as adoption of the technology and how it'll touch all. There's a lot of room for growth here. I'm gonna, I guess throughout this conversation, because we have the institutions well represented, I may take the other angle.
Yeah, I definitely have some more specific.
Yeah, and I think it's good. Not that I disagree. I come from an institutional background, but I think it's good for me because from where I'm at right now. It's interesting with cryptocurrencies. What this environment is. Here you have this group of open source code that sits out there, right? The original was BTC, Ethereum, and then we have 1,000 other cryptocurrencies. In my view, there'll always be 1,000 different cryptocurrencies. There'll be private, consortiums, private blockchains, public blockchains, and they're all going to fill their niche as they solve problems that exist in the marketplace. But the development of this is really interesting because it's all open source code. And around BTC, you have some of the smartest people that I've ever met in my life, developers that are working on that aspect of it. And also, Ethereum and others. But whenever something is invented, right, and what that is it's a new piece of code or a new way of doing things, whether it's proof of work, proof of stake, or whether it's how are we going to scale BTC. as solutions are proposed and new tokens come out there on the marketplace, all the other developers in the community, they see what's going on. They're communicating with each other, and they see the new innovations. And Bitcoin itself, BTC, is changing all the time. You may not know this. It's not a Model T, and it was just invented and it's staying exactly the way it is. It changes all the time. It's not the same Bitcoin that it was when it first started. And so you have this hyper innovation going on within this community. And as we've illustrated, which I'll illustrate again, is the reason why this whole thing is not hackable and it's a safe place to work, because it's not a computer, it's a community, right? As Emmanuel and Kell have illustrated before, it's a community. I can go online to GitHub, I can download the code, I can modify it, and I can change whatever I want to change on it. But the community will reject it, right? So there's no way. I mean, anybody can change the code, but you can't. Well, maybe we'll get some mind reading or some mind manipulating technology in the future. But you basically have to, get everyone to agree in order to modify any one of these tokens. But Paul, take it where you'd like to take it, and I'll answer some questions.
Yeah, sure.
As a consortium, well, I'm from a couple of consortiums, USC, Utility Settlement Coin, I'm the steer co for Credit Suisse, I'm on the board of R3 and others. And the question was, why do we work together? We work together because, to your point, we're trying to save money. And we have to recognize that, not only all think that all banks, not all banks compete in the same way, so we're not all made the same. Some banks focus lower down the stack. Custody banks, for example, aren't the same as investment banks. So it's not quite kumbaya, but we do have to recognize that we don't really compete on middle and back office. So where we first establish that as the ground floor, then we kind of, it's actually quite interesting. What we do is we actually get in the room, we figure out, if we're trying one person's expense is usually another person's revenue. So we've got to figure out whose revenue we're trying to take out. And that's how the consortiums are really that's how you really get down to the grassroots of what you want to build. And you maybe have a 3-year plan and say, well, we're going to take out this bit of expense for now, but in the room, the person who's closest to that expense line might be worried. But they should be in the room. Why? Because then it gives them an opportunity to pivot, to think about a new opportunity for themselves. We know where this thing's going to end up. So you're better being in the conversation on the inside than being outside and wondering what's going on in that consortium.
And from a public standpoint, of public blockchains, right? There's an opportunity for individuals to choose between personal responsibility and freedom versus having a custodian or someone control. If you look, and one of the reasons why people are motivated to completely eliminate those third parties is because of the misuse of some of these systems of trust. If you look in Venezuela, for example, or you look in Argentina, or you look in Greece and Spain, in which these central banks have debased the currencies and have caused great pain and even death, I think, in some of these places. And as cryptocurrencies evolve, there's another story there to be told where the masses, the public, are looking at a potential exit from the system that they feel has abused them in the past. And the blockchain technology, Bitcoin or some other cryptocurrency, offers that opportunity for liberty and freedom. But with that comes personal responsibility. Whenever we have liberty, we have personal responsibility, and whether the public will accept that or not is still yet to be seen. But there is a story going on right now in the world where people, and I know this because I have students that provide liquidity to these people around the world, and are looking for ways to have that freedom. And it provides a lot of friction. It creates friction among banks, but mainly among regulators in various jurisdictions. There's a lot of friction because, well, you can't have your freedom because you could do something wrong with that freedom, right? And so we want to try and control it.
Just to follow up on a little bit of that point, this might be kind of sideways, but one thing that I think is really important for the public blockchains, as far as your perspective of it, is to kind of not entirely think about it from a US-centric standpoint. As you mentioned, if you talk to someone, people go, oh, Bitcoin is too volatile. Look at it going up and down. That's just crazy. I could never trust something like that. People in Venezuela think it's stable compared to their national currency. Okay? Think about that. I mean, don't think about it from a U.S. standpoint. Also, if you're thinking about ICOs, people are like, why don't the SEC and the CFTC, which by the way had great comments last week at the Senate hearing, why don't they do something about these things? Less than 18% of the ICOs are from the United States. So we're part of a phenomenon that is global in nature and is changing and has potential to do great changes if you just think about it from that standpoint. The democratization of investment and innovation, especially if you look at underdeveloped nations. I know people in Africa are using it because their banking system is corrupt and slow sometimes. And if you look at, I mean, why wouldn't an innovator that has a great idea that doesn't have access to all the capital that we have in the United States be denied the ability to create their invention or their idea? Well, they can now with ICO mechanisms. So I would just, kind of encourage everyone to not think about it with a U.S. really centric viewpoint and not be parochial in that regard and think about the potential for the technology, on a global basis.
What happens when you connect 6 billion people to the global markets that haven't been connected before? What happens?
It's an interesting point, and I think a lot of those international ICOs, they actually prohibit U.S. investors from getting involved for the very regulatory issues they're concerned about. But so I guess if we're just to ask another question, kind of public versus private, are the private blockchains really in a position to compete? If you're taking a legacy platform where you have to run these legacy concurrent systems and at the same time you're trying to implement some blockchain solutions, meanwhile you have these private systems that are all very kind of scrappy, startup oriented, flush with capital in many situations, building from the ground up. Are they going to be in a position, is it going to be kind of an evolution where some of these just public blockchain models maybe become a little more disruptive, whereas the private consortium-based models are just kind of structurally disadvantaged?
I don't think. I was basing this. I don't think that there's a competition between public and private going on.
Or do you see these two merging in some way?
I ultimately do think they will merge, but the public blockchain networks have to solve KYC, AML, OFAC, because the banking industry, the financial services industry, it is regulated, and you do have to know your client. You do have to make sure you have to know uses and sources of funds. You have to know that the person you're dealing with on the other end isn't in a sanctioned state. So for instance, I'm going to go back to Ian. If I'm doing a KYC Ian, he and I do a transaction together. He's a trustworthy American, whatever. And then he gives me a public key that actually belongs to, is that Harold? Yeah, and Harold, by the way, Harold's at the front here, and he doesn't look like a North Korean national, but he actually is. And he gives me Harold's public key. So I think I'm dealing with Ian, but he gives me Harold's. That's called man-in-the-middle fraud, right? And because blockchain, I can't actually tie the public key to him. And it gives me somebody else's. I've just now sent money to a North Korean national, which is breaking the OFAC rule. So they can come together, but there's some things that have to be improved upon first in order for that to happen. And there are 11, I've come up with 11 different ways in which you can break either the current regulations in either the US, the UK, or any of the major. I just come up with 9 major ones, which is what that said are problematic. But I don't think there's a competition between private and public. There really isn't.
I would say overall there's different styles of innovation. So public is going to be probably a little more innovative in terms of consensus mechanisms and some other things. But the rate of innovation on public will be greater. And interestingly, if you look at private consortium, they're dealing with some other issues. So some people are talking about putting big records on blockchains. Blockchain handles small amount of data. Most of the time you're storing big data like documents, x-rays, things like that off-chain. You're storing a hash of that data and a pointer to it in the blockchain. So how to handle data and how to do certain things like ordering and keeping a great transaction speed are being pioneered within private blockchains like Hyperledger Fabric. which, by the way, just got to 1.0, I think, 6 months ago. Again, talking about how new this stuff is. So I think what's going to happen is that most of the innovation will happen across the public blockchains, and then the private ones or consortium ones will kind of pick and choose on a slower basis which ones to incorporate. But by necessity, they will be incorporating things that actually they need to make business work. So in that particular way of doing things like blockchain data, they will be doing innovation that's not necessary for the public chains.
Yeah, I think we're in consensus on this one. I was managing technology within a Fortune 500 environment in the late 90s when, as the internet came on. And internally, as an entity, we were looking at creating an intranet, and also within the city, the municipalities were looking at creating an intranet, these private networks, right, on the internet. And what happened, what we found over time, is that innovation happened much more rapidly on the public internet as opposed to an intranet. And therefore, we wanted to adopt those products and services that were now available on the internet, and then we created VPNs, right, and new ways to take advantage of those public services. And so I think without question that the public blockchains, from an innovation standpoint, will outpace those that are centrally controlled, just because we can't innovate as fast, we can't take as many risks as an institution.
Yeah, you mentioned Hyperledger, which is a private blockchain kind of consortium company. It's not really a company, but it's an organization of the Linux.
It actually has 2 or 3 blockchains.
Yeah, so we had a conversation with, just a little side note, with the executive director there recently. He made the point that if we're always doing this comparison between development of the internet and development of blockchain, this feels like 1998, the development of the internet, where it's gotten to the point where if you are a leader of a Fortune 500 company and you're not paying attention to blockchain, you're probably doing a disservice to your shareholders. So it seems like it's starting to reach that kind of point of like no return, the kind of critical mass point. However, the private side is much harder for the average person to engage with, right? To invest in. So maybe we can talk a little bit about investing in crypto. That might be an interesting conversation. Maybe there's some places people don't want to go, but any thoughts that you guys have or can provide just around, if you think of your average sort of investor who's got a 401k, maybe some stocks that they're involved in, and they're thinking about, they're seeing all this news about Bitcoin and all this, all this activity. What are they? Is there a way they can get exposure? Should they get exposure? Should people be involved in this stuff?
I'll take that one on. I think everyone should diversify a little bit of their portfolio into the cryptocurrency space. That piece of your portfolio for high-risk investments. I think as far as high risk goes, it's an asset class that will likely outperform every other asset class in that sector from a risk-adjusted standpoint. And so I think there's a good long-term investment to be made. I mean, it's growing according to Metcalfe's law. It's n squared, n being the number of users, and as the community grows, the user base grows, the value of the whole network grows exponentially, and that's going to reflect in value. And so there's a good long-term play there from an investment standpoint, but you got to put that in perspective and do it according to your, the way you manage risk. The thing that's unique about cryptocurrencies, though, is there's still a lot of friction, and it's clunky. It's not like you can go on E-Trade and throw money into an ETF or whatever. You got to go on some crazy site like Local Bitcoins and find somebody who wants to buy it from, or go onto an exchange, Coinbase or someone you can buy a little amount. So it's a little, and then you have to take ownership of the private keys if you really want to keep it secure, and know how to back that up. So it's quite a bit different than traditional asset classes. It's a little more complicated. I think this coming year is probably the year of institutional money. My fund is designed for institutional investors, and I've seen a lot more institutional interest in the cryptocurrency space. I think in 2018, we'll see many billions of US dollars flowing into this space, which will continue to drive the value up.
Yeah, I thought maybe I would just check if there are any questions from the audience.
Same question, but how about companies? If you were going to, what stock would you buy because of what a company is doing in terms of advanced crypto blockchain efforts?
So the question is, should we invest in companies that are developing the cryptocurrency space, or should we invest in cryptocurrencies tokens themselves? Is that what you're asking?
Right, and
yeah.
I really believe how do you invest in blockchain? Because that's where the real innovation is, as opposed to just owning a cryptocurrency.
The challenge is, when you say blockchain, it's actually not just blockchain. As Emmanuel said, blockchain is an antiquated database that you'd rather use Oracle or SQL or whatever, right? It's one component of 4 different components that make up this technology, and it's what was in Satoshi Nakamoto's white paper. So the only thing you subtract out is the monetary policy at BTC, and the rest of the technologies apply. So your question is, how do I invest in this technology without necessarily investing in BTC? And the answer to that question is, I think that would be a poor move. I think that the institutional players are going to be investing in, actually, in my opinion, and this is where I'm putting my money, is in BTC over 2018. The reason why, because BTC provides some infrastructure, liquidity, some ways of managing risk, more so than other cryptocurrencies. But that doesn't mean that BTC is going to end up being the winner. That's yet to be seen as we go ahead, and other cryptocurrencies. I think the better bet is to place your investment into a range of cryptocurrencies over the long term, because investing in companies that are involved in this space is kind of like, it's like betting in technology companies in the 1990s as the internet's coming on, right? Then we had this boom and this bust. Most investors will lose money in this space as they invest in these ICOs that make promises that they don't keep. And after a while, when they don't fulfill on the promises, those values will go to zero. Meanwhile, you'll have the 2% of companies that will be the next Google, the next Amazon, the other big companies. This innovation will fundamentally change our landscape. But it's going to be a small percentage of these tokens that have the most profound impact, and many of them are going to have unfulfilled promises, and investors will lose money. So if I was advising you, I would keep focus on the big winners in the cryptocurrency and put money straight into those cryptocurrencies and hold them.
Slight different. No. You can invest in blockchain. You can short. You can look for companies that are because really we keep talking about innovation, but we're really talking about I think it's 5, but 4 or 5 fundamental technologies that are like 1970s, 1972, right? So Merkle trees, 1976, Ralph Merkle wrote the white paper. Hashing, been around for 25, 30 years. So the technology, that's how you get this immutable thing. The technology itself that underpins blockchain is actually really old. The innovation is in the business models that you build on top using these things. ICOs they're not new. They're a Kickstarter based around a smart contract that tries to enforce the rules around how the founders are going to get paid. It's an alternative way to raise funds for your idea. Today you go to a VC and they reject 99% of the ideas that go to them. Now you can go to the general public and you get access to the funds. What you're buying is the business model. So danger of that, quite right, is most of them are going to go to zero. They're not all great ideas. Some of them may well be. And you've got to do your homework. I think there is an opportunity in shorting potentially disrupted markets and companies. Look into those and you'll figure them out. There's an opportunity if you're long semiconductors, you're long ASIC cards, you could probably short those at some point because you're going to go to GPUs, you're going to go to, it's a different way of calculating the hash in Bitcoin. Ethereum's already changing, or stated it's going to move to proof of stake, which doesn't use the ASIC cards. So there are opportunities out there beyond just investing in Bitcoin or Ethereum to make bets, but you just got to do the work, you got to do the homework.
Yeah, I would say right now there's not really a public vehicle for companies, but echo Emmanuel's comments is that you want to be, I think probably in a year or two we'll have someone like a Chain, which is a great company doing a lot of great work, and some other larger companies. Right now they're mainly smaller, innovative companies, right? The thing to echo his short comment is that you want to wait for Netflix to come out, and you don't want to be associated with Blockbuster, right? So the people who are ignoring blockchain and aren't looking into it and aren't doing things like the various alliances and participating and learning and starting to deploy it. As I said, we're early. Right now, the only viable, and I don't know what I do not know what the price of Bitcoin will be in a year, so don't ask me. I don't have any advice in that way, but I will say that it's early for public regulated vehicles by which to invest in blockchain, but you can sure tell the companies that aren't pursuing this avenue, and I would use that as an indicator.
Yeah, I mean, as an equity analyst, I get that question a lot, actually. So I jotted down some examples of some public companies that have exposure. There's not really pure plays, but Square, for example, is selling Bitcoin through their Cash app. So that's going to be a small piece of their business, and their stock actually kind of moves with the price of Bitcoin. PayPal is a company that I think will eventually get involved in this, and I've publicly said this. And so, I think that there's a potentially interesting way to play that, but they're not doing it now. And then you have the chip manufacturers, AMD, NVIDIA. Both of those stocks have moved a little bit on their exposure to mining chips. I have no official view on whether to own those. You also have things like the Bitcoin Investment Trust, and there's another vehicle they just launched yesterday that includes a mix of cryptocurrencies. You've got Overstock.com, which is launching a T0 token. And Atari Coin was announced the other day. So if you're lucky and you own something and they put Bitcoin in their name, the stock's going to take off. Kodak Coin is another example. There's a company in Japan, SBI Holdings. They actually hold more value in Ripple than the market cap of the company. So there's a lot of somewhat, indirect, non-pure play ways to invest. Also, you can think of an IBM or an Intel or an Accenture. They're all developing Bitcoin practices, consulting practices, but we have no idea how big those businesses are going to get.
I have a question.
Yeah, yes, please go ahead.
And this is different, I think, than what you all have maybe even thought about talking about today. But I'm thinking about the social implications of what you're talking about, which are, we're going to eliminate our operations department at JP Morgan and Goldman Sachs. And these are all middle-class jobs that have been available for generations. And it's not just the financial services, but I'll pick on financial services because that seems to be where there's a lot of movement. And so I'm wondering if the people who are involved in implementing these technologies are thinking about the disruption so that we're not sitting here 20 years from now and saying, gosh, we have a structural unemployment problem. We should have thought about that. Didn't we learn anything from outsourcing or some of the structural issues that we have now?
Well, so I'm a computer science grad from Georgia Tech, so I'm probably biased toward technology a little bit. I would say that all of our technology has implications toward, eliminating and automating parts of enterprises. And so from a social standpoint, I think that's just part and parcel with today's economy and technology and growth. This is just another aspect of that. When you brought up social initially, I mean, the thing that I first thought about was all the implications for social good. So the ability to have a Facebook type operation where my participation is actually benefiting me through some kind of token allocation that tracks what I do, and by giving you my data, I make a contract with you that you give me some kind of compensation for participating in your network. The ability to do voting, where my vote could be hidden and private, but I can still know that it counts, and be doing some kind of zero knowledge proof, like I know my vote was there, I know the vote's accurate, but no one knows that's me because it's my right to have a private vote. There are several dozens of applications for social good that I think far outweigh what I consider a natural progression as technology in general develops across the world.
Kell said what I was going to say. Technology has been disrupting jobs from the beginning of time, ever since the wheel was invented, right? We've got transportation, automobiles. I mean, technology disrupts jobs. What it does is it shifts workforce from one type of job over to other types of jobs, and humanity adapts. But the social good from cryptocurrencies is amazing. There's some data out there that suggests one of the biggest uses of Bitcoin right now is actually charity. And I know this within my organization. There's a lot of organizations out there. It's difficult to move value into these areas of need throughout the world, and BTC is being used to do that. It sometimes looks like money laundering, which is unfortunate, and it's a difficult thing to navigate because, here you are taking U.S. dollars and trying to move value into a place in the world to build a hospital or to build a well, but we navigate that environment. But there's a lot of social good that comes from this. I mean, but even AI too. AI is a big disruptor that's going to happen over the next decade. So I think the overall good, though, that comes from technology, in my opinion, there's a lot of social good that comes from this innovation.
And just to echo that, when you're dealing, say, with donations to underdeveloped nations or areas of need, combine that with a smart contract that guarantees the recipient gets it, and that it doesn't go through a series of fraud, graft, deception, and theft, and that you can verify through smart contract combined with some other technologies that, when I give $1, it gets transferred into a crypto, goes through a smart contract, and that the actual recipient is the people that I want to receive and to help. So in that way, I think it's a great enabler.
Can you hear me? My question is somewhat along the line, because I come from this more as just a traditional business person and investor. But when I see breaches in Equifax, on the scale of that, when I see the kind of intrusion that foreign government, state-sponsored actors can make into our computer systems and into our financial systems, and when I see the hacks that Bitcoin has suffered, and or at least that I have read about it, maybe you can expound on that, because your reaction makes me think maybe I misunderstood something about that. But, I see this as being such a leading edge, and I think it's an inevitable wave. I think this job displacements, everything that's been talked about, and the transformation of our society is going to happen. But it also seems that we're at a really vulnerable spot where there are probably really sophisticated players on the dark side of this as well. And how do we address that in a way that ensures blockchain technology is really as tight as it sounds like it will be?
Okay, I'll just start from the standpoint that Bitcoin has never been hacked. What gets hacked are exchanges. So if you the equivalent of saying like the United States dollar has been hacked when someone goes into a bank that has a vault with a one-number combination or something like that. So it's really, when you see like the Mt. Gox situation or BTCE, or I forget the name of the Bitfinex, the name of the exchange in Japan, these are private enterprises that have built their own code around the exchange of fiat, which is, a centralized bank currency for crypto. And as a result of doing that, they manage private keys, which is how you get access to crypto. Their software that they wrote to manage their business of exchanging crypto for dollars is what gets hacked.
So how do you as an individual know that you're parking your money through, say, Bitcoin in the right location?
Well, anyone who has been in crypto for a while uses the exchange to purchase or sell crypto, and then gets their crypto off the exchange immediately to the private wallets. Okay? That is a private enterprise that happens to be a gateway to purchase and to sell crypto. And they have their own standards. Many of them are not in the United States. The ones that are, the main ones are Coinbase and Gemini currently, but Kraken, now that it's up more than a day at a time. But yeah, there's some work to be done there. And just to mention, I almost use Equifax as an example. So if you have a blockchain-based identity similar to what I used, the example of a Facebook type situation, why was, this again goes to centralization. Think about this. Equifax, Experian, TransUnion, your school, your job, everyone has a copy of your data. It is, you probably have, my data is probably out there 200-300 times. And they all have different security policies. They all have different capabilities. What if it was on one blockchain and I could give segregated access to the people who needed it? Maybe at the liquor store I prove that I'm over 21. What if for hospital records I prove this part of that? By giving them a portion or exposing kind of a version of the identity that there's one, it's in one place, I control it, and I give access to it. Which is a better model? A secure blockchain that I give access to and can revoke access to? Or 300 centralized entities that all have all of my data? I know what I would rather have.
Yeah, and to be clear, the blockchain is unhackable. It's not hackable. And Bitcoin has not been hacked ever. And it is probably the most secure way of moving data. What it is these keys, as Kell just said, these keys. And you can only move data on the blockchain with a key. So you either hold that key yourself offline where it's inaccessible, write on a piece of paper, scramble it up with some other words so that even somebody got the paper and looked at it, they wouldn't be able to figure out what it was, right? There's all kinds of ways to do that. And as a hedge fund manager, you know, when you have $1 billion in digital assets sitting there and the keys have access to it, you know, those keys are not online for anybody to access. They're not available. We connect to a network just to move some of the assets and we disconnect immediately. So those private keys cannot be accessed by anybody. So the thing to do is either secure it yourself or to hire somebody that you trust to do it, like an expert or a fund manager or something to hold it.
Question. Why do we need the currency part, the coin part? Can you hear that?
So the question was, why do we need the currency
Why
part?
do we need the currency or the coin part? Because that is a representation of value. Why not just use dollars?
Why not use fiat? So the original experiment was to solve the double spend problem, and it was and it has its own valuation. I actually kind of fell in love and then fell out of love again with the whole token notion. And the reason for that is because tokens are a binary representation of the value. So it's like going to the casino, I go to the cashier window, I give them fiat, I get tokens, I get chips, go play a bunch of games. When I'm done, because I want to buy my milk and my bread and my eggs in dollars, I go back and change it to dollars and my up or down. But actually the way financial services works is actually slightly more complicated than that. They work in benefits, obligations, and rights. So an example would be so in the example before, if I own a house and it was represented by a token, I could give you the token and now you own my house. The way that we actually really work is I might have the right to live in my house, the benefit of capital appreciation if the house goes up in value, and the obligation to mow the lawn because I live in a nice neighborhood. But if I rent the house to you, you only get the right to live in it. You don't actually get the right to the benefit of the capital appreciation or the obligation to mow the lawn. So actually tracking assets in the way of using these kind of coins is actually a kind of a misnomer in financial services. Much better to represent them as a smart contract. That's why smart contracts are really powerful, because you can actually represent those things. You can grant rights, obligations, and benefits. The coin part of it is really from its roots as from BTC, and it kind of causes some of the confusion as to what is a cryptocurrency versus what is a crypto asset, and we're basically changing the terminology as we're coming up with these different use cases. So for instance, I think someone mentioned up here about gold. I think it was Ryan. If I have an asset that's 1-for-1 matched to make it up dollars, is that really a cryptocurrency, or is that just a ledger entry representing my ownership of real dollars in a bank? So really, if the currency has if the crypto has an independent valuation to the underlying asset, then I call it a crypto. Whereas if it doesn't, if it's really pegged 1-for-1 and it's the same value, then it's really kind of a crypto asset. It's really a ledger, and what you're doing is you're using it as a method to define ownership.
So there's so many ways I could answer this. Let me just start with a practical example. The limitation on Bitcoin is 21 million coins. It can be subdivided to 8 decimal places. And I don't think you want to be tied with something that has a lot of regulatory concern and is printing $80 billion a month. So it's deflationary in nature. It's a completely different type of currency. We've never had that scarcity. There will only ever be 21 million. This is part of the design. This is the first mover for blockchain. And it's simply the first digital currency to be used on a global basis. Now, lately there have been some ideas to tether certain currencies to the US dollar, but again, this is global in nature. This is something that the world has never seen before, a completely digital currency that is by nature deflationary, So it's just the way it was invented, the way it's thought about, the way the economics of it work, particularly for Bitcoin, it just doesn't make any sense. We could talk further about that offline.
And I'll add to my associates really quickly. You know, as far as the payment system goes, we have a better payment system today than the blockchain, right? Agreed? We're on consensus on that. We have the US dollar and Visa, MasterCard, the payment system is much better. But it's kind of like the invention of the automobile back when it was invented. And the automobile is sitting there on this dirt road, right? You have all these critics looking at the automobile and saying, you know, that's never going to work. It doesn't work as well as a horse and carriage on these roads. There's potholes and so forth. And the regulatory bodies step forward and say, well, you know, if you're going to drive an automobile on the road, you need to have 3 people. One person with a flag out front as it's moving the automobile, right? It's kind of a technology in which the whole environment, the ecosystem, is not really set up and established for that new technology. And therefore, there are a lot of easy ways to criticize it, right? But then the next thing you know, you're launching a Tesla into space, right? I mean, next thing you know, you have Tesla and driverless cars and so forth. That's where we're going with this system, and that's where eventually it's gonna end up. As far as the value behind it, I get asked this question all the time. What gives Bitcoin its value, and it's the same thing, everything its value. It's the value that we as people attach to it based on the features that we find usable. And with regards to gold, gold is scarce. That's one of the attributes. It's somewhat fungible. It's divisible. You can shave pieces off. You can melt it down to smaller pieces, right? It's somewhat portable. You can put some gold coins in your pocket and you can go, you know, down the street and buy a cow. At least you used to be able to do that, right? And so all of these different features that gold has given gold its value over many millennia. What gives Bitcoin, and other cryptocurrencies as well, but I'll just say Bitcoin for right now, BTC, its value, is the attributes that it holds. And the attributes that gold has, actually Bitcoin does better, as Kell just described. There'll only be 21 million. The scarcity is finite. In the year 2140, the last Bitcoin will come into existence. The exact supply is known. Even though gold is scarce, we don't know exactly how much gold is in the earth, right? It's more portable. You can move billions of dollars worth of it all over the world, almost instantaneously, right? Within 10 minutes. But then, so it has features that gold has, but it has some of those features actually better. It's more divisible and fungible and so forth than gold. So it has those features, they're superior features, the same thing gold does, but it also has additional features, as we've talked about. And that comes in the other cryptocurrencies. It has the ability, it's programmable money, right? We can program on top of it. We can innovate on top of it. We can create these smart contracts and do all kinds of other creative things. So it has even greater features. So it's all these features that give it its value. And why people are using it and adopting it. And as more use cases come about, what's going to happen? People are going to find more uses for it, and that's going to increase the value of it. And the way that works, according to Metcalfe's law, is if I had a telephone, right, and I was the only person that had a telephone, my telephone wouldn't be very valuable. But if you got a telephone in, and I had somebody to call, all of a sudden, my telephone becomes more valuable. And then everyone here in the room gets a telephone, and now we can all call each other. Indirectly, my telephone now became more valuable, right? So this is Metcalfe's law, which is n squared, n being the user squared. A network, Bitcoin is a network, and it's going to grow in value exponentially based on the number of uses and use cases. And those use cases are being created, that innovation is happening, and therefore it's going to continue to grow in value. And that's actually the case for investing in this space too.
I just want to add one. I heard somebody answer that question in an interesting way once. If you think of MasterCard and Visa as a system, euros and dollars are currencies. MasterCard and Visa doesn't work without currencies, and the currencies don't work, at least in a digital system, in a digital environment, without a system like MasterCard and Visa. Bitcoin combines the two. It's an integrated system and a currency. So we can debate digital asset currency. But so it's a really unique creation that we just haven't seen before. An ability to just kind of have something that functions as both a monetary system and a monetary currency in one. And I think the value kind of derives from that. Yes?
Just a quick question about the Visa and MasterCard analogy. Let's say you made a transaction and you realize that that's wrong. You just want to dispute. Is there a dispute mechanism in Bitcoin?
So,
blockchain?
Thanks for the question. Yeah, thanks for that question. I was going to just jump in before you and actually talk about, because I don't think that Visa and MasterCard necessarily are the best networks. And the reason why I say that is because they mimic Diners Club, right? That's where their networks. But the system they're based on relies on something, a 16-digit number, 3-digit pin on the back and your zip code. And you give that number out to a bunch of different people that you seemingly trust or don't trust, and you hope that they take exactly that amount of money only on that day and never more. And if they take more than that, you say, well, don't worry about it, man. My bank's going to cover me and return my value. But that comes at a cost to you in your APR and your interest rate. Versus the way Bitcoin works is actually a push technology. The only way you can get my Bitcoin is if I send it to you. You give me a public key, I send it to you instead. It's not a pull method, it's a push. So it means that actually networks that work in the push method are actually far more secure and reliable and don't have the element of fraud. So I actually argue that the method is actually better. You want to jump in?
Yeah, I mean, if you think about it today, every method of payment besides cash, you give the entity that you're paying the data required to do it. So why would I give my bank account number to the person that's debiting my ACH? Have you ever been caught by an ACH that keeps continuing and doesn't shut down? Or a recurring credit card that keeps debiting? In order right now to make payments, I give them the ability to make unlimited payments. I give them control of my data again, just like the Equifax example. And right now, currently, it's irrevocable in terms of sending a payment. If you use someone like a BitPay, they have refund mechanisms built in for merchants, and they can handle that just like any other payment. I mean, think of it as cash, but I think in the future, as we evolve a little bit more, you'll have smart contracts that do built-in escrow that are surrounding this payment. But as Emmanuel said, as far as being a push payment, I shouldn't have to give the details of how to make a payment and the authorization of the payment to the person I'm paying. I should simply be able to send them the funds and retain control over my payment method.
Can you all talk a minute about concern or just the management of risk associated with finding fundamental weaknesses in the underlying algorithms of encryption or hashing that could result in instability if somebody was able to exploit one of those weaknesses?
Well, it's been getting hammered by every hacker in the world for 8 years, and it has never been breached.
And I'll add one more thing to that. And also with quantum computing, they have been able to hack the SHA, right, hash, and Bitcoin is, and all cryptocurrencies, it can change instantly, right? As soon as someone is able to use quantum computing to create a reasonable threat, the code will change and it'll be exponentially more difficult.
You do have scaling issues, though. I mean, you do have, when it comes to Bitcoin specifically, the number of transactions that you can process per second is very low compared to like MasterCard and Visa, the fees. So these issues can be resolved, but right now those impediments are built into it.
Well, two quick things. If quantum computing starts breaking keys left and right, I think Bitcoin will be the least of your worries, because everything being decrypted around the world, there'll be bigger issues, from nuclear codes to all kinds of things, your bank accounts, I mean, everything. And then scaling is an issue, and that's what people are working for. That's where some of the forks have come through, like Bitcoin Cash, and then you look at some emerging technologies that are being piloted right now, like Lightning, which does the analogy of taking a Bitcoin like a bar tab. So you put a hold on the Bitcoin transaction, then you can sit there and deal with an entity and do multiple transactions, and once you net it out, you put the results of that bar tab back on the blockchain, which increases scalability in a huge way.
But you should all know that Bitcoin is designed slow for a reason, right? It's a public network, and it needs time for everybody to actually understand, to get consensus. So there is a trade-off for security versus speed, and which is why permissioned blockchains will have a place, as well as public blockchains. The design of Bitcoin, that 10-minute window, is actually, by design, it actually self-adjusts. It always tries to be at 60. Every 600 minutes, it looks back and says how quickly was the last how many blocks solved, and it self-adjusts, and it's doing that deliberately because it needs to give the network of nodes enough time to verify like 4 + 4 was actually 8.
maybe one last question. Anybody?
Hi, can you speak a little about how the value that's being transferred relates to the value of the underlying asset? So for example, you talked about you can transfer the value of a hotel, a deed. What if that hotel burns down? Where does the value change within the network? You spoke about a disruption to supply chain network where pharmaceuticals could transfer from the manufacturer to the end user. Where does those pharmaceuticals are still in a different place, how does that transfer?
The supply chain example is actually as far as tracking and provenance. So it wasn't financial in nature. So the value wasn't being kind of addressed there. If you have what I call a representative token that's representing a physical asset, obviously there's a mechanism in Ethereum called an oracle that interacts with other data sources, so you'll have to have some kind of system in there as part of that. But I did want to say one thing is that if you look at settlement, like T+2 is happening, you know, in stock trades and things of that. Usually, I think it originated from the bicycle messengers back in New York, like having to go through dirt roads and things like that to get from place to place. But an interesting thought for, you know, pure virtual financial instruments, say like a bond or something like that, is that the token in certain cases can take on the value. So in essence, the trade is the settlement, or the settlement is the trade, right? So maybe there's not even the concept of that. It's like if I gave you a $10 bill and asked you to settle, it wouldn't make sense, right? So there's some interesting things to think about in terms of when you have tokens representing financial instruments versus tokens that represent financial instruments. And again, this is separate from doing immutable consortium tracking of logistics things like pharmaceutical creation and transport for purposes of safety and regulatory compliance.
Yeah, and you just said it, Kell. The network just enables the secure transfer of the asset. It doesn't give it its value, right? We give it its value. But I think Kell said everything else.
Yeah, just one. So what will happen in the very near future? I think Wyoming just passed the law like last week. I know Delaware did the same thing. Many assets these days, financial assets, are actually no longer actually put into paper form. So you can actually materialize them directly in a database. And those will effectively be what Kell's talking about, which is the actual blockchain itself is the reference asset. There is no underlying somewhere else. And that, I think, will become the norm for financial instruments. When it comes to real world assets, you know, if it's like you think about if you bought a house today, you go in, you're in the room. Do you actually own the house when you chink the champagne and you all celebrate and the money's moved? The actual answer is no, you don't, because the actual title hasn't actually transferred until it's filed about a week later. So that celebration is actually premature. If the legal office or the real estate office that you were in celebrating blew up and that paperwork was gone, you could probably go figure out, you know, and prove over time that you actually own the house. But you'd have a job to do, and that just proves that you didn't actually own the house. Once title is actually held on the blockchain, that's when it's actually digitized, and it's a digital asset at that point.
I think maybe you're kind of getting into the realm of smart contracts too, where, you know, you make an agreement. When something happens along the product or supply chain, something else will happen. That will trigger something else. Well, you could have exceptions and conditions that occur along the way that you weren't expecting. The problem with smart contracts is how do you build all those exceptions into code? And that's why very complicated smart contracts are going to be a ways off until people really know how to codify those things in a way where you don't need human involvement. So you're probably always going to have some level of human involvement in a lot of these things. Okay, great. How are we on time?
I just want to thank our esteemed panel and Paul for such an educational session. Thank you so much. And want to thank Bob Verady for putting this event together along with our programs committee. This is phenomenal. Thank you so much.